I'll start my presentation. So the agenda for today, and really I think what Vasu kind of shared with everyone earlier on is very relevant because ETFs does kind of give investors a means to invest in many of the macroeconomic trends that Vasu has actually mentioned earlier on. So our agenda for today is kind of stated here. We will try to kind of answer what are ETFs, the types of ETFs and what has worked during this period of COVID-19. I'll touch a little bit on the longevity, diversification, and rebalancing aspects of ETFs. I'll touch on risk as well as end off with tips for investors. Okay, so what are ETFs? ETFs are really exchange-traded funds, and they are a unit trust fund that is listed on an exchange. It's really nothing very, very complicated. They trade like normal stocks and shares, right? So they're all listed on an exchange, and they typically track an underlying index. Most of the ETFs in the market today are all passive ETFs. In that there's no active management, no element of active management. They all track an underlying index, and they really allow investors to gain exposure to a specific asset class in its basic form. So for example, like equities, bonds, or even commodities. And if you will go to the SGX website, under the ETF section, you'll be able to kind of see a few of these ETFs that are already listed on the Singapore Exchange. So for example, like a gold ETF, an ETF that tracks the Straits Times Index, the STI, and even an ETF that tracks investment grade corporate bonds. Other types, ETFs also allow investors to kind of gain access into certain thematics, in the world today, as well as all specific strategies like smart beta. Now, on the topic of thematic ETFs, thematic ETFs is a rising trend, in the world as also in Asia. And this is particularly true, after the financial crisis in 2008. They give investors exposure to very specific trends like environment, 5G, robotics, or e-commerce. And what I try to show here in this chart that you see is the total return performance of various indices, right? These are the various indices that ETFs can track. It's probably about 3 decades or so. But what's really, really interesting here, you would see is that, post 2008, thematics and technology has really outperformed the market. And Vasu kind of touched a little bit on that as well. And specifically, if you were to look at, the theme of global internet, that has got the most spectacular, performance, partly due to the large exposure or component of e-commerce companies, right? So, really, ETFs does allow investors to get very narrow exposure and potentially look for more performance. A little bit on smart beta ETFs. This term has been thrown around quite often within the investment community in recent years. Smart beta, put loosely, it really involves identifying certain financial or market factors in order to beat the market performance. So traditionally, indices, are kind of weighted, be it indices on stocks or bonds, they are traditionally weighted by market value. So so basically, the performance is really more a function of how large, a company is, for example. So in recent years, ETF issuers have come up with other parameters, to create more innovative as well as better performing products. And some of these parameters can include like higher dividends, a focus on earnings growth, or just a differentiation between large cap companies versus small cap companies. Specific to the COVID-19 environment, a lot of investors, based on what we see, favor ETFs that has got a tilt towards higher dividends. And this is quite intuitive, given that the interest rate environment is quite low today. Why do ETFs make sense? One of my personal favorite reason is really what I term longevity. And I kind of just to give you a sense of what I mean by longevity here. So, if you kind of look at one of the oldest indices, today, globally is the Dow Jones Industrial Average, and this index was created almost more than 100 years ago, in 1896, and back then it only has 12 companies within this specific index. And you'll see here that the companies include cotton companies, sugar, tobacco, electricity, even cattle, and basic commodities like coal and iron. But what happens is that when you zoom forward, after 100 years or so, you would see it, and this chart shows you this, the components of the Dow Jones Industrial Average in October 2017. You'll see that all the companies that that was in the index many years ago are no longer there. And this really brings up the point that an index, the interesting property of an index in that it is what I call self-renewing. So really, modern industries, can replace the old ones here, and it allows investors to kind of ride through market cycles. So if you look at what's the more representative industries today, in the US market, it'd be like pharmaceutical companies, technology companies like Microsoft, Intel, and even like banks like Goldman Sachs. And the point that I really want to make and emphasize here is that when you buy into an ETF that tracks an underlying index, the index does, kind of rebalance, or refresh itself over time, such that the larger and more relevant companies of the times gets included, and the older, less relevant companies and industries get, kind of excluded from the indices. So it does really kind of help investors manage the risk across various market cycles. The ETF really kind of in this way, stays there for 100. So if you have an ETF that tracks the Dow Jones Industrial Index, you can kind of think of it as over the past 100 years or so, the ETF really doesn't change. It's always there, but the underlying companies just renews itself. So, some other basic reasons why ETFs make sense for investors. 3 reasons here. They have significantly lower fees and expenses than unit trusts. I mean, in the context of Singapore, unit trust funds or mutual funds typically carry, an expense ratio of probably 1% or more. And for ETFs, typically, based on what we see, the total expense ratios can be about 50% or less. They have fully transparent holdings, meaning that whatever that you buy, you see it. So it's pretty clear to you, as an investor, what the ETF holds and what you hold, as an investment. And of course, being that it's traded on an exchange, it gives investors much greater accessibility in terms of when you want to buy it, when you want to sell it. It's just a lot more accessible there. The next kind of section that I want to kind of talk a little bit is really on the importance of diversification and rebalancing. And here is a nice little picture here of, which really tells you never put all your eggs in a single basket. I took it on my own. Hopefully you find it, hopefully the photo is well taken. Now, the importance of diversification. Diversification is really about risk management, right? More than anything else. I think that's kind of the most important message about diversification here. And what I tried to show here in this kind of busy chart here, apologize for that, there's just a lot of disclaimers, is really to show the long-term performance, let's say you're a Singapore investor, of REITs versus, Singapore equities versus Singapore bonds. So in a way, kind of the 10-year performance, total return performance of these 3 very basic asset classes that is available, to investors in Singapore via ETFs listed on the Singapore Exchange. And what you will see here is that, for sure, where I highlight, when I kind of circled red, is of course the big sell-off in March this year. I mean, given on the onset of COVID, and I always tell our clients, as well as partners, if you were an investor holding on to 100% Singapore equity portfolio in February this year, and you were expecting a great year, you would have lost 50% or more of your capital, right? But if you had diversified it, you would have more capital. So this is a simple but important point, in that diversification helps you as an investor preserve your capital. This chart here, is just an extension of a point on diversification. And what I'm trying to show here is more like, more like a concept of the efficient frontier. And so, how do you read the chart that I have here? So assuming that you own 100% of your money in a single stock, and that's represented by the red dot, alphabet A, right? There is low return and low risk, and you want to kind of earn more performance, right? So you want to get more exposure in a more risky, higher performing stock B, right? So really, as the point here about diversification is that, rather than switch all your holdings, from A to B, if you actually hold and diversify your investments from a 1 to 2 stock portfolio, it potentially gives you better risk-adjusted returns, right? So, and that's kind of reflected by the red line in the chart, which I've named called the efficient frontier. And so having a portfolio, thinking from a portfolio perspective, it can be quite rewarding. And of course, the disclaimer here is that, in order for this to work, investors should understand that the correlation between stock A and stock B is important. Ideally, they should be negatively correlated, which means that when one goes up, the other should come down. Right. Moving on to the importance of rebalancing. So this is really a similar chart, that I've kind of showed earlier on. But, I thought about it, like how to explain the idea of rebalancing and the importance of rebalancing to investors. And one of the ways, I think I can put it in a simple to understand manner is that markets undergo different cycles. All right, and different asset classes, themes, even strategies, they just respond differently. So, and rebalance, if you're able to rebalance your portfolios, or whatever investments that you hold, through these different cycles, you actually can kind of end up with a more efficient portfolio. So over the same 10 years that I've kind of showed earlier on, in terms of the performance between Singapore equities as well as Singapore bonds, you'll see that there are actually many periods over the past 10 years where the markets actually went through a bit of stress. So in 2011, you had the European sovereign debt crisis when banks in Europeans sold down and there was a lot of issues on the CoCos. Then in 2013, the taper tantrum when Bernanke wanted to raise interest rates. Of course, in late 2014, you had the price war between the US as well as the Saudis. And of course, in 2016, Trump's election 4 years ago, where the market was very nervous just prior to when in the presidential election, a run up to the presidential elections. And last but not least, you have the COVID-19, early this year. Now, so volatility during all these periods is really very high. I mean, it ran anywhere from between 10% to about 30 or 40%, as much as 50 sometimes. But of course, if you were aware of all these events, and I wouldn't kind of term them as actual cycles, but even just if you were aware of all these events that were happening around the world, and you kind of during these periods you understood the risk involved, and you kind of diversified some of your portfolios into fixed income, away from equities and into fixed income, you really do end up with a much better and more efficient portfolio, and ultimately a better investment decision. So what are other risks involved when investing in ETFs generally during COVID-19? That really only 2 points I really want to share. The first point is that ETF shares is very important that investors understand that ETFs share the same risk as the underlying asset class or strategy that it really tries to track. And and I think Vasu has already kind of shared a lot of his views and outlooks with you in the earlier part of the presentation, and these are really important points to keep in mind. So for example, if you buy a REIT ETF, you really should try to understand some of the developments that are happening in the REIT market, right? So those are the best indicators for you when you're as your best investment guidelines. The second is really on liquidity risk, and this is very, very important when it comes to investing in ETFs. There are many dimensions to liquidity risk for ETFs. One dimension is the premium and discounts, that they can fluctuate. and sometimes they can widen quite a bit. By premium and discount, what I'm just trying the definition here is really the percentage differential between the traded price of your ETF relative to the underlying net asset value of the ETF, right? So that can fluctuate. For Singapore ETFs, what we observe is that they're all pretty well run, especially at least for the ETFs that Nicole has. The premium discounts are typically between plus minus 20 basis points, which is very small. The second component to liquidity risk is bid-ask spreads, right? Bid-ask spread is essentially the spread between the ask price, and the bid price of any ETF that is traded out there. Of course, investors really want to go for the tightest spreads possible. There is a misconception that ETFs, at least the ones listed on the Singapore Exchange, have very low volumes. There are many reasons to that. Partly also because ETFs in Asia is a fairly new development, right? But the misconception is that on-screen volumes being low does not always mean that the liquidity, overall liquidity of the ETF is low. This is due to the dual layer property of ETFs. And what do I mean by the dual layer of liquidity? In that really ETFs trade in two markets, right? There is a secondary market, which we kind of define it as what happens on the exchange, right? And there's also a primary market, where investors can directly create or redeem, with their ETF units with the ETF issuer through participating dealers who are really brokers. There's really no real, the mechanics of both markets are slightly different, but generally, the reason why they exist is because of order size more than anything else. In the primary market is typically where large institutions with very large orders wants to transact. And if they cannot find the liquidity on the exchange, they would just trade directly with the ETF issuer. So really just two channels in which liquidity can be generated for ETFs. Some strategies for rebalancing, and these are more like I'll just kind of run through them at a broad level, especially in this period of COVID-19. Given all the risk that kind of Vasu also shared earlier on. Value and diversification is important. That's the first point. Second, really do, if you have all equity, do consider, diversifying it into a bond equity portfolio. Core satellite is useful if you kind of maybe gain exposure to the market via ETF, and then you kind of have your tactical trades on single stocks or single securities, right? That can be quite effective. And of course, dollar cost averaging, when markets are bad, dollar cost averaging is never a bad strategy in my view. 4 things to look out for, in ETF fact sheets. So here in this slide is just a cutout from one of our own Nicole Asset Management fact sheets. So some of the more important things that investors should take note of, first maybe would be on the fund size, how large the size is. And really, when I say fund size, it's not really, I'm not alluding to a liquidity proxy or anything. It's more that, typically when the fund size is larger, it just represents that the fund is more successful, right? If you kind of think of it as a business, the bigger the business, probably, is a little bit more successful in attracting assets. So I like to look at fund size because of that. The second thing would be on the index. Now, actually, the index is the first thing I would look at. Essentially, it is what the ETF tracks on the underlying asset class or strategy, or exposure, if you call it, right? So that's the index, really important. That's what you buy. And the third will be the total expense ratio, what you pay. And I say total expense because I want to look beyond just management fees. I want to understand all the fees involved, right? Total expense ratio. And last but not least, tracking error. This is more like a mechanical metric that we look at, but very useful because it helps. The lower this number, it helps investors understand how well the portfolio manager is tracking the index, right? So the lower the tracking error, the better the portfolio manager is doing his job, and the better the overall liquidity management around the ETF. Okay, so with this, I have gone into my last slide. As key takeaways from my presentations, I will just share that ETFs really offer a cost-effective as well as flexible way for investors to invest in COVID-19. And then when I say flexible, I really mean that there are many ETFs out there, with exposure to different asset classes, fixed income bonds, gold, corporate bonds, REITs. It allows investors to express views quite easily, right? Second, remember the concepts of the benefits of ETFs given their longevity, especially passive ones, their longevity and the diversification that they offer, because you're always buying into a basket of securities than just a single security. Number three, approach the market with a strategy. And I've kind of shared earlier on some of the strategies that investors can consider. And last but not least, keep in mind the two main risks when you kind of think about buying ETFs. Always consider what asset class are you buying into, and have a good sense, or try to get a good sense on the liquidity risk or liquidity profile of the ETF. So with this, I thank you very much for your time, and I would pass my time back to Melvin.